Welcome to the Deep Dive, where we cut through the noise and get straight to the essential insights. Today, we're taking a deep dive into the fascinating and, frankly, often misunderstood world of al-Rayn. This is the core concept of mortgage or pledge within Islamic finance. Our main source here is Shari'ah Standard number 39, which isn't just theory. It's a really comprehensive framework. It outlines the specific rules and, importantly, the contemporary applications of al-Rayn.
Yes, and what's particularly insightful about this standard is how it provides such a detailed, practical guide, for both financial institutions and individuals. It ensures these, crucial transactions are firmly rooted in specific ethical and financial principles. It really builds a foundation of clarity and fairness.
Indeed. So our mission today is pretty clear. Let's demystify al-Rayn. We want to clarify exactly what it is, how it practically functions, and explore its surprisingly broad applications in modern finance. We'll cut through any potential complexity so you can grasp the essentials quickly and clearly. Okay, so let's begin right at the foundation. What's the overall scope of this standard? What kinds of pledges are we talking about here?
Well, it's quite broad, actually. This standard covers pledges that institutions might request from their clients, to secure debts, but also pledges that institutions themselves offer to other entities to secure their own obligations. And it even extends to situations where institutions are simply holding pledges as agents or custodians for other parties.
Okay, so it covers multiple angles.
Exactly. And at its heart, al-Rayn basically means designating a specific financial asset, or maybe its equivalent value, as security for a debt. The crucial idea here is that if the debtor can't repay, that debt can then be collected directly from this specific asset or its value. And this isn't some modern invention. Its permissibility in Islamic law is, deeply rooted. We're talking Quran, Sunnah, centuries of scholarly consensus.
Right.
So this foundation naturally leads us to ask, how do these core principles translate into the very specific, actionable rules laid out in the standard?
That's a perfect lead-in. Let's delve into the actual mechanics of the al-Rayn contract itself. How binding is it, for instance?
Okay, well, once the contract is signed, it's immediately binding on the mortgager, that's the person or entity offering the pledge. And here's a key distinction. The mortgager cannot just decide to cancel or end the contract once it's made. They can't unilaterally back out. However, the mortgagee, the one receiving the pledge, does have the option to choose to cancel it.
That's interesting. A sort of one-sided cancellation right. What about taking possession of the asset itself? How does that work, especially with different types of assets?
Right. Possession, or qarb, as it's termed legally, is critical. How do you actually take control? It can be real possession, like a physical handover, handing over car keys, or it can be constructive. This means establishing control through things like official registration, documentation, maybe like a land title deed.
Okay, so paper can be possession too.
Precisely. And the standard allows the asset to be held either by the mortgagee directly or by a mutually agreed upon third party, a custodian. And it's explicitly stated that neither the mortgager nor the mortgagee can just transfer the asset to someone else without getting mutual consent first.
Makes sense.
And importantly, this is quite powerful, the mortgagee can even be authorized in the contract to sell the asset if there's a default and recover their debt without needing to go to court first.
That direct right to sell, without needing a court order, that sounds like a significant efficiency point. Maybe something often overlooked compared to conventional finance.
It definitely streamlines the recovery process for the mortgagee, yes. But as we'll discuss, it's balanced by, ethical safeguards to protect the debtor too.
Good point. What about continuity and termination? Like, what happens if someone involved passes away?
Interestingly, the death of either the mortgager or the mortgagee doesn't automatically terminate the mortgage. Their heirs simply step into their shoes, and the obligation continues.
Okay, so it survives them? How else does it end?
Well, it can end if the asset itself is destroyed, unless, of course, it's replaced by some kind of compensation, maybe an insurance payout. It also ends if the mortgagee decides to terminate the contract, as we mentioned they can, or obviously upon full repayment, or if the debt is forgiven. And finally, if the mortgagee simply waives their right to the pledge, they just give it up.
Got it. And this leads us to this concept of the right of retention. Can a mortgagee hold on to the entire pledged asset, even if only, say, a small part of the debt is still outstanding?
Yes, they generally can, unless there was a specific prior agreement allowing for a partial release as the debt is paid down. This flexibility lets the mortgagee maintain their security throughout. But, and this connects to the bigger picture of fairness, it's important to understand that a mortgagee cannot retain that pledged asset for a new debt, not one that arises later, unless, that is, it was specifically agreed right up front that this pledge would secure any future debts, maybe within a defined time frame.
Right, prevents scope creep on the pledge.
Exactly. It stops a mortgagee from leveraging an existing pledge for totally unrelated new obligations down the line.
Okay, so having covered the legal framework and possession, let's talk about the asset itself. What kinds of things can actually be pledged under Al Rain? I suspect it's broader than just, say, a house.
Oh, absolutely. The core requirements are pretty straightforward. It has to be a valuable asset. It needs to be clearly identified, whether by description, name, or specific reference. And crucially, it must be deliverable. You have to be able to hand it over physically or constructively.
Okay, valuable, identified, deliverable.
Right. And while we often think of tangible assets like property or goods, it can also be a debt owed to the mortgager, or even cash, or fungible goods like, grains or oil.
Fungible goods. Now, here's where it gets interesting for me. What about perishable goods? Like, if you pledge a truckload of fruit, what happens then?
Good question. You can't exactly keep fruit locked away for years. The standard is practical here. It says perishable goods should be sold. And then the money, the proceeds from that sale, that becomes the actual pledge. The value is preserved.
Ah, okay, that makes sense. Sell it, pledge the cash. What about pledging something you only own a share of, like part of a building?
Yes, that's allowed too. You can pledge an undivided share in a property, which is quite common as long as that share is known, quantifiable, and the share itself is sellable. Now, imagine a scenario where multiple lenders have a claim, a mortgage, on the same asset. How does that work?
Yeah, priority issues.
Exactly. The standard is very clear. If all the mortgagees are equally ranked, everyone involved needs to agree on major decisions about the asset. Consensus is key. But if they are ranked, say, one lender has a senior claim, another has a junior claim, then generally only the consent of the lower-ranked mortgagees is needed for the senior one to act on their rights. It establishes an order.
Right, maintaining fairness among the creditors. This seems to touch on the concept of trust, or amana, doesn't it? The idea that the asset is held as a safekeeping by the mortgagee or custodian. What does this mean for risk if something happens to the asset while they're holding it?
Precisely. It's held as a trust. So this means if the asset is lost or damaged without any negligence or misconduct on the part of the holder, maybe a fire, a flood, something unavoidable, the debt itself still remains. The holder isn't liable for the loss of the asset in that case.
Okay, so act of God, the debt still stands.
Correct. However, if the asset is lost or damaged due to the holder's negligence or, misconduct, then that negligent party has to guarantee its value. They're liable for the value at the time of loss. And importantly, even in that case, the original debt still remains owed by the mortgager.
Okay, so negligence makes the holder liable for the asset's value, but doesn't erase the underlying debt. What if the asset is lost while the mortgager is still holding it, maybe before handover?
If it's lost while still technically held by the mortgager, then they generally won't provide a substitute asset of equivalent value. Unless, of course, the mortgagee specifically agrees to waive this right.
That certainly seems to protect the mortgagee quite strongly. Let's explore some more nuanced situations. Can you pledge something you don't actually own, like maybe an item you've borrowed or rented from someone else?
Interesting scenario. Yes, you actually can, but only with the explicit permission of the actual owner. If that borrowed or rented item, pledged with permission, were eventually sold to satisfy the debt, the original owner would be entitled to get its equivalent value back from the mortgager. Their rights are protected.
So the owner needs to be fully aware and consent.
Absolutely. And a really practical application of these principles is in sales contracts. A seller can actually stipulate, right in the contract, that the item being sold will itself serve as a pledge for its deferred price once the buyer takes possession. This gives the seller immediate security for the payment.
Like built-in collateral.
Exactly. And one more detail. Any growth or income that comes from the mortgaged asset, whether it's naturally connected, like offspring from livestock, or separate, like rent from a pledged property, that growth or income also automatically becomes part of the pledge. Unless, of course, the parties specifically agreed otherwise beforehand.
Okay, that covers the asset itself pretty well. Now, regarding the use of the asset and who pays for what are the rules there? Can the mortgagee just start using, say, a pledged car?
No, not freely. The mortgager, the owner, can use the asset, but they generally need the mortgagee's permission to do so, as it might affect the asset's value or availability. The mortgagee, on the other hand, cannot use the asset for free, just can't do it. They can use it, but only if they pay a fee, like market rent for it, and even then, only with the mortgager's explicit permission.
So no free rides for the lender. What about upkeep? Who pays for maintenance?
Necessary maintenance costs, the expenses needed just to prevent the asset from deteriorating, those are the responsibility of the mortgager, the owner. Now, if the mortgagee ends up paying these costs, maybe the mortgager isn't doing it whether they had permission or not, the mortgagee can seek reimbursement. Or, interestingly, they might even be allowed to use the asset themselves, but only to the extent of the expenses they incurred.
Okay. What about the costs of the pledge itself, like paperwork, holding it, maybe eventually selling it?
Generally, those types of expenses related to holding, documenting, and ultimately enforcing the pledge by selling it, those typically fall on the mortgagee, the lender. Unless, again, the mortgager explicitly agrees in the contract to bear those costs, it defaults to the mortgagee.
Right, that seems like a robust system for tangible assets. But what about more intangible things? We touched on it earlier, but can you really use a debt itself as a pledge? How does that work?
Yes, absolutely. It's permissible to pledge a debt. This can be a debt that someone else owes to the mortgager, or even, in some cases, a debt owed by the mortgagee. Possession of a pledged debt is established differently, obviously. It happens by possessing the supporting document, the proof of the debt, or maybe by having the pledge formally witnessed. And once that's done, the mortgagee gains priority rights over collecting that specific debt.
Okay, so you possess the paperwork or the legal right.
Essentially, yes. Of course, it has to be a legitimate debt, something Islamically valid. You can't pledge an illegitimate debt, like one arising from gambling or interest. And here's a really interesting detail. A debt can even be pledged before the contract that actually establishes that debt is finalized.
Really? Before it even officially exists?
Yes, it allows for certain forward-looking security arrangements, particularly in commercial dealings. It provides flexibility. However, there's a limit. Pledging is not allowed in contracts that are purely based on trust, like safekeeping arrangements, known as wadi'ah. The nature of those contracts isn't about securing debt.
Got it. That clarifies the scope pretty well. So, the inevitable question. What happens if the mortgager defaults? What are the mortgagee's rights and, crucially, limitations then?
Okay, default scenario. The mortgagee has the clear right to demand the sale of the pledged asset if the debt isn't paid when it's due at maturity. Now, if the sale brings in more than the debt owed, any surplus goes directly back to the mortgager. This is fundamental. It protects the debtor from predatory practices and ensures the asset's true market value is realized, not just enough to cover the debt.
That's a key protection. And if the sale doesn't cover the debt?
If there's a deficit, if the sale proceeds aren't enough, that remaining shortfall stays as a debt owed by the mortgager. But here's a cornerstone principle, a really important ethical line. The mortgagee can never simply stipulate that they automatically take ownership of the pledged asset upon default. It must be sold.
No forfeiture clause, basically.
Exactly, no automatic forfeiture. However, the mortgagee is allowed to buy the asset themselves from the mortgager, but it has to be at the current market price. They can then deduct their debt from that purchase price. It's a purchase, not a seizure.
Right, a fair market transaction. How does this fit into bankruptcy?
Good question.
Yeah.
If we connect this to the bigger picture of insolvency, if the mortgager unfortunately goes bankrupt, the mortgagee who holds a pledge has priority. They get first claim in collecting their specific debt from the proceeds of that pledged asset. If any funds remain from selling that asset after their debt is fully satisfied, then those remaining funds are distributed proportionally among the other unsecured creditors. It maintains fairness across the board, respecting the secured position.
That provides a clear and, it seems, quite equitable framework for handling default situations. Now let's shift gears a bit and look at how these principles actually play out in today's, dynamic financial world. Where do we see Al-Rain in action beyond maybe simple physical assets or basic loans?
Well, it's quite adaptable. Take securities and Sukuk Islamic bonds. It's definitely permissible to pledge legally issued and traded securities and Sukuk certificates. This even includes things like Sukuk al-Manfa, which are a fascinating type. They represent shares in the benefits or usufruct of specific assets, rather than direct ownership of the asset itself.
Like pledging the income stream from an asset.
Sort of, yes. It shows how Al-Rain can secure a wide array of modern financial instruments. Now, what about current accounts? Can you pledge the money in your bank account back to the bank itself? Generally, no. A standard current account held at an institution usually cannot be pledged to that same institution to secure a debt to them, unless the party specifically agreed to transfer those funds into an investment account. Then it operates more like a mudaraba, a profit-sharing partnership, where the bank can invest those funds, and that investment can be part of the security structure.
Ah, so it's about the nature and purpose of the account changing. What about units and investment funds?
Yes, Islamic institutions can absolutely pledge investment units held in Islamic investment funds. And they also have the right to restrict withdrawals from those pledged investment accounts, but only up to the amount of the outstanding debt. They can't just freeze everything indefinitely.
Okay, that makes sense.
And just like with other assets we discussed, any profits or growth generated by these pledged investment units or accounts, that also becomes part of the pledge automatically. Again, unless there's a specific agreement stating otherwise.
So the security grows with the investment. What about pledging things that don't exist yet, like future crops?
Another intriguing application. Yes, you can pledge future assets, like future yields or produce. Think of pledging the future harvest from a specific, clearly identified farm or orchard. As long as the underlying asset that will generate the future yield is clearly identified, the pledge is valid. It really highlights the forward-thinking aspect of the standard.
It's quite flexible. And what role does insurance play in protecting these pledges?
Insurance, or rather its Islamic counterpart takaful, is addressed directly. The mortgagee can actually require the mortgager to take out takaful on the pledged asset and name the mortgagee as a beneficiary. Takaful, importantly, isn't like conventional insurance. It's a cooperative system based on mutual assistance and shared risk. So if the pledged asset is lost or destroyed and a takaful compensation payout is made, that cash compensation then takes the place of the original pledged asset. The security essentially transforms but remains intact.
Okay, the insurance proceeds become the new pledge. Now, this raises an important ethical and religious question. What about zakat, the obligatory charity? Is zakat due on assets that are pledged?
Yes, absolutely. Zakat is due on the owner, that's the mortgager for the pledged asset, and any growth it generates. This obligation remains even though their ability to freely dispose of the asset is restricted by the pledge. And the standard specifically points out that all cash pledges are subject to zakat, according to the relevant zakat standards, ensuring that this fundamental pillar of Islamic finance, the ethical distribution of wealth, is upheld.
So wrapping this up, what does this all mean? We've really gone deep into Al-Rain, haven't we? We've seen its clear definitions, its strict yet surprisingly flexible rules, and its versatile applications from very basic contracts all the way to complex modern financial instruments like sukuk and investment units.
Yeah, and if we connect this back to the bigger picture, I think this standard really powerfully highlights a comprehensive and, importantly, an ethically driven approach to securing financial obligations. It consistently emphasizes fairness, transparency, clarity, and protecting the rights and interests of both parties involved, all within a framework that aligns deeply with core Islamic principles.
And for you, the listener, we really hope this deep dive has provided a much clearer understanding of how these Al-Rain principles work, how they underpin specific financial agreements and act to protect transactions within Islamic finance. Hopefully, it's a valuable shortcut to feeling well-informed on this topic.
Definitely. And then maybe a final thought for you to consider, to mull over. How do these detailed and ethically grounded principles of Al-Rain, with their focus on fairness, asset sale over forfeiture, and clarity, how do they challenge or perhaps complement your understanding of collateral and security as it works in conventional finance? What new questions does exploring this robust framework maybe prompt you to ask about financial safety, about responsibility, and about what truly equitable dealings look like in the world of finance?